Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. Just to provide you a little bit of perspective in terms of our agenda, topic is common sales tax filing mistakes and how to avoid them. As we work through this and talk through the materials, some of these are going to be very, very specific to the actual filings themselves. Others are a little bit more oriented towards overall sales tax compliance activities and some of the pitfalls of managing sales tax compliance. Certainly they have a tie-in with the filing piece of it, but I think you'll probably recognize that some of these are more specific to sales tax in general, while others are more specific to the actual filing process itself. As background information, just quickly on myself and Jeff and our business, if you're not familiar with TaxConnex, we do focus specifically in the sales tax space. We're about a 100-person firm. We're based here just outside of Atlanta. The core business is sales tax compliance in terms of outsourcing of the preparation and filing of the returns. We also have a consulting practice, which my partner here, Jeff, heads up, where we deal with fairly common types of questions would be, where do I have nexus and where do I have taxable sales, and what's my risk and exposure from a sales tax perspective. So those are all topics and issues that Jeff frequently deals with. So without further ado, we'll jump right into the presentation, and the first topic is related to nexus. Jeff?
Thanks, Brian. The starting point for almost every discussion we have around sales tax, particularly with new entrants into the sales tax world, is nexus. Nexus being the term used to characterize someone as having a presence or a connection with a jurisdiction such that that jurisdiction can impose its taxing authority on the company. Not to insult anybody, but we're now almost 6 years into, actually, 6 years into what we all refer to in the sales tax world as the Wayfair decision. And in our little world of sales tax, we think that's a big landmark decision that most people know about. But if you're newer to sales tax, or you just aren't connected with the sales tax compliance environment, it may be something you're not as familiar with, and that's okay. It's understandable. I'm a sales tax nerd, and I hope no one else on the call is. And so what we're talking about is economic nexus. And it's basically a determination that came about from South Dakota enacting legislation that allowed the state to assert nexus if someone had an economic presence in their state. Why is that unique? Why was that legislation necessary? Well, historically, when we talk about sales tax nexus, we refer to it in the context of physical presence. Physical presence being having an office in the state, an employee in the state, inventory in the state. And as the economy changed and the marketplace started to become more online related, there became sort of this feeling of a vacuum associated with brick and mortar stores losing sales to the internet, and those operating in an e-commerce or internet capacity weren't necessarily registered or compliant with the sales and use tax laws of the state. So the states felt like there was an erosion of their sales tax base in these types of scenarios. So South Dakota enacts legislation around economic presence or economic nexus, and ultimately it gets up to the U.S. Supreme Court, and the Supreme Court rules favorably, and thus opened the door for states to enact their own legislation across all the states that have a sales tax for economic nexus purposes. And that's exactly what happened. So in today's environment, and the thing that's important to understand is there's kind of two things that can create nexus for you. One of which, and the more probably prominent one today, is economic nexus. And the reason I say more prominent is because it doesn't require physical presence, meaning more people are going to be exposed in that way. Just by way of having revenue directed to any particular state could in fact put you in a position where you need to get registered and comply. If you want to kind of take something from this call in the way of guidance relative to what does economic nexus mean and how would we define it, the best way to say it is that just think about $100,000 in gross receipts. If during a calendar year or a 12-month period you exceed $100,000 in sales to a state, and this is basically predicated on you either delivering services to a customer in that state or delivering tangible personal property to that state. And using that $100,000 sort of threshold as a guide, it's at that point where you ought to probably take a look at your activities in more depth and understand the economic nexus laws in that particular state in more depth. Not all economic nexus laws are the same. Some are more broad and encompass all gross receipts. Some are more specific and maybe focus only on tangible personal property or focus only on taxable sales. So it does vary from state to state. We also reference in the presentation 200 transactions. There are a number of states that do have a transaction threshold in lieu of a revenue threshold. So it could be that you have less than $100,000 in gross receipts or sales, but you have 200 transactions or more during that 12-month period or calendar year. That too could trigger nexus. Now there's fewer states that enacted a transaction threshold, and in fact, some of those states have started to repeal those transaction thresholds from the economic nexus threshold or standard. So anyway, I think from this call, what you want to understand, if you don't already know it, is economic nexus is a thing. If I've got more than $100,000 in sales in any given state during a 12-month period, it's probably time to take a look at your activities and drill down. In the next several slides, we're going to talk about what you would look at next and how you would make some of those determinations. But it's important to understand that there are two levels of nexus still. There is a physical presence standard that didn't go away. That's just been the historical standard that everybody based their decisions on. We didn't have to overlap with that, the economic standard.
And Jeff, kind of tying this back into the topic of filing mistakes and how to avoid them, certainly a big issue or mistake would be obviously not knowing where you have nexus and not filing at all. I think that's really what we're trying to identify here, and how to avoid that issue is, as you referenced, the $100,000 threshold to kind of monitor that. But then what about from a physical presence perspective? Do you encourage people to look at that maybe every quarter, every 6 months, every year? What's a good practice on that to avoid, triggering physical presence and then not knowing it and not filing?
Yeah, I would say that typically I would look at it at least annually and just revisit your physical activities. Some of those activities would include not just having a formal office in the state or having an employee in the state. It might also involve having sales reps visiting the state periodically to solicit. It might involve attending trade shows. It could expand into a couple of other categories. And if you're in a service industry, you might want to really check this more often than once a year, maybe every 3 to 6 months. And the two examples I'll give you, one would be if you're leveraging third-party resources within the state to deliver a service on your behalf, that is an element of activity that can trigger a physical nexus, and the state would assert you have a collection or a sales tax obligation. The other is you're directly performing services in the state. Maybe you're in a contracting business where you're not regularly operating in every state in the country, but every once in a while you get a big project for a specific period of time in a given state. It's just important to recognize that at that point, because you have that physical presence, you have to be aware, alert, and compliant with the sales and use tax from the very beginning of that contract or that project.
Perfect. Those are good guidelines there. So we'll move into taxability here next.
Yeah, I think after we talk about nexus and have a comfort level with whether or not we have nexus, then it's a matter of, are we making any taxable sales, or do we have an obligation to comply for any reason for sales and use tax purposes in the state? So in this conversation, we're going to assume we have nexus, and when we think about sales and use tax laws, that the baseline is typically the sale of tangible personal property. So the statutes of almost every state will kind of introductorily communicate that any sale at retail of tangible personal property is subject to sales tax. And from that point, we start to absorb what we call exemptions, and there also are inherent in that statute what we call exclusions. And services, in a lot of ways, are excluded from tax. And what do I mean by excluded? It just simply means that they're not referenced. There's no statutory language that taxes them to begin with. And in the absence of something that says your service is taxable, it's excluded from tax. It's the equivalent of being exempt. And we use those terms exempt and excluded interchangeably. But in a lot of states, there are generally a lot of excluded services, but don't get too comfortable with that statement. That's probably the area that gets people in trouble, is because from state to state, the level of tax on service elements varies and can vary dramatically. And it's not uncommon, for example, for companies in technology to be operating in the state of California for a number of years. And in the state of California, it's pretty common that most things like downloaded software, services related to IT activities are excluded from tax. And so when those companies start to establish nexus outside of California, there's this tendency to say, well, that's the way the sales tax law works. And lo and behold, they're operating in a state like Texas that does tax downloaded software, or a state like New York that does tax downloaded software. So the implications of that can be dramatic and devastating for companies in that scenario. And again, it's about monitoring your nexus footprint as well as the taxability of your products and services. There's a whole host of things that we call exemptions as well. These exist in industries like manufacturing, where the state has created incentives to draw jobs into the state by creating exempt treatment for manufacturing equipment, machinery, and other related supplies. There's also another level of exemption that goes beyond the products themselves and gets into either what the company is doing in the way of business or how the company is structured. And what I mean by that is, if you're a nonprofit organization, you may find that your purchases are exempt from sales and use tax in a number of states. Not all states. It's important to understand that. But there are a number of states that afford exemptions in that capacity. Same with government, state and local government. Federal government is exempt from sales tax or excluded from sales tax, however you want to term it. It's really exempt from sales tax everywhere. There are some mild exceptions to that rule. I'll give you some hints of New Mexico and maybe to some degree in Washington. But for the most part, sales tax cannot be imposed upon the federal government. State and local governments, again, just like nonprofits, vary from state to state. But I think that the thing that brings or ties the the discussion about exclusions versus exemptions together is that exclusions, again, are not represented in the statutes. They're not taxable under any circumstance. Exemptions are otherwise taxable transactions, but for the fact that I'm selling it to an entity using it in an exempt capacity. And usually, almost, I'd say 9 out of 10 times, when something's exempt, it's only exempt to the extent you get a valid exemption certificate from that customer. So they have to validate and substantiate that they're buying it in that exempt capacity. So those are some of the key factors to consider and monitor when you're looking at taxability. Don't rely upon your home state or what you've thought to be the tax treatment of your products and services for a number of years. Always be open to the fact that it's going to be different in another state, or even some of those states are going to change their rules.
Yeah, and Jeff, let's tie this back into the filing process as well. And I know a question we often get related to taxability and filing is, let's say we're operating in a state, and you had referenced California before, where we have nexus, but we have non-taxable sales. So we don't have any tax to report, but we do have nexus. What's your advice and perspective on registering and filing in that scenario?
Yeah, there's probably 3 different scenarios that it's a great question that kind of illustrate what you just asked. One of them that's probably the easiest to answer is if the products or services that you provide are service-oriented and purely excluded from sales tax in that state, you will have no sales and use tax compliance responsibility. That doesn't mean that if you're operating in that state in an office capacity and you're buying supplies, materials to facilitate the provision of your service, that you won't have a sales tax obligation when you buy those products. And you could have what we refer to as a consumer's use tax obligation in those scenarios. A consumer's use tax obligation comes about usually because you've purchased from a vendor who's not registered to charge and collect sales tax. They haven't met the nexus standard yet, but they are selling a taxable product to you. And at that point, you're obligated to self-accrue and remit that tax directly to the state. The next scenario might be that I've established nexus in the state, I'm selling otherwise taxable tangible personal property, but for the fact that my customer base is exempt. In other words, they might be buying for resale. They might be buying as an exempt entity or a nonprofit organization. And it might make the most sense to look at that and confirm first that I've got all of the adequate documentation to substantiate my claim that all of my sales are exempt. And once you have that in place, there are some states that would not necessarily require you to register. A lot of states statutorily are probably still going to want you to register because you've got nexus, you're making sales. But there could be a good business case for not registering in so much as you've got adequate documentation that if you were audited, you could substantiate your sales weren't taxable. Doesn't mean there couldn't be some minor penalties that would be imposed for just failing to register and file. So it really does depend on the state. I would say that majority of the time, we're not pushing clients down a path of registering under those conditions. And then the third example is where you're just not adequately set up to manage exemption certificates to a degree of confidence that you're not going to have some slippage. You also may have a little bit of variability with respect to your customer base, such that from time to time you are selling to a taxable customer, or you potentially could sell to a taxable customer. It's nice to think that maybe we've set up an online product that's only marketable to a state and local government, and it's always an internet transaction, and we kind of rely upon the fact that they're state and local government customers, and we assume that's always going to be the case. And lo and behold, other people start popping into that website, or perhaps there are teachers within that state and local organization who individually and independently go onto your website and buy products. Now they're buying products as teachers, as individuals, as common citizens. They may not qualify for that exemption. So it might be healthy to sort of anticipate some of that. And one of two things might be a good outcome out of registering there. One, it just keeps your eye on the ball. Maybe you set up your tax calculation engine or software to just monitor that. If you don't have an exemption certificate, it automatically charges tax. The other is you get a statute of limitations running, meaning that if you're registered for a period of time and you're filing, even though you're filing zero-due returns, the failure to charge and collect that tax might be eliminated because the statute of limitations runs and the state can't go back more than 36 or 48 months to assess you on that transaction. So everybody's circumstance is different. Everybody's risk tolerance level is different. So we do try to take a lot of things into consideration when we're analyzing whether or not to recommend registration or not.
Yeah, and I'm glad you mentioned that statute of limitations aspect once you register, because I know we've had some clients that have somewhat, I don't want to say forced us, but required us to go down that path, and it's definitely something to consider, even if you don't don't have any sales tax to report. But I think the next topic here is related to managing and updating the tax filing calendar.
So yeah, I think again we're kind of stepping through the life cycle, or maybe not the life cycle, but the evolution of a compliant taxpayer. Nexus, let's assume, has now been established, and we've done our diligence around taxability. We're definitely going to have some taxable sales. So at that point, we've got to register for sales and use tax purposes. What does that mean? Well, it just means you're basically applying for a license to be able to charge and collect sales tax on behalf of the state. Now, that's not necessarily a privilege, I understand. It's more a requirement. So not only is the state requiring you to comply, but they're also requiring you as part of that compliance to register the business so that you've got an identity within the state's framework by which you can then report and remit the taxes you charge and collect to your customers. Once you start that process and that registration activity expands across multiple states, there's a need for you to really understand the importance of maintaining a tax calendar internally and keeping up with your filing requirements. And that's inclusive of not just where am I registered, but what filing frequency is that state assigned to me. The states can assign you any number of filing frequencies, including being required to file monthly. You could just be required to file quarterly. Sometimes it can be as seldom as semi-annually, and then there are also annual filers. And then the very rare circumstances, there can be what we call occasional filing frequencies. They're so rare that I won't talk about them too much, but it's just good to understand that those filing frequencies exist, and they vary by state potentially. So you need to keep up with that. The other thing that's important to understand, especially from a state sales tax perspective, is that you're likely to have to file online electronically through the state's portals. So you're going to have to set up login credentials. Sometimes those are set up at the time you register, because most of the registrations are also done online. Sometimes it's after registration, when you get your account information, that you go back in and you establish login credentials. And so there's just a number of things that can play out for companies at different levels. The last thing I'll mention, and it may or may not be something you personally need to worry about, but as a company grows, as a company gets more substantial and their collections and remittances are more substantial, some states will go to deposit requirements or prepayment requirements. And what does that mean? Well, in some cases, it means that on the 15th of the month, you have to make a prepayment, and then on the 30th of the month, you actually file the return and make the final payment or the reconciliation payment. So you're actually monitoring your collections during a cycle. Sometimes that prepayment is just an estimate. It's a predetermined calculation based on your prior history, and you're kind of forced to make that payment in between regular filings. So there can be a lot of nuances along those lines that are just important to keep up with. And, if you are going to manage something like this in-house, if you don't have that tax calendar, and the tax calendar essentially is just a matrix, an Excel spreadsheet that just lists the states, the filing frequencies, the account numbers, the login credentials, and any other unique requirements. If you don't have something like that, you're at risk when the person that does know what's going on leaves the company or, God forbid, has an unfortunate timely death. You lose sight and visibility. And once you do, you can run into some really significant challenges, including financial implications, penalties and interest, namely.
And Jeff, related to this tax calendar and the registration process itself, I know one of the issues that we've seen, especially when we've taken over the filing of the returns for our client, is that they've registered for the wrong tax type based on their type of business and the type of sales activities they have in the state. Would you care to elaborate on that at all, or have any thoughts on that?
Yeah, it's tricky, and some of these states will have very, very definitive requirements as to whether or not you're charging and collecting and remitting sales tax, which is an intrastate transaction, whether you're charging and collecting use tax, which is generally a transaction where the product originates from outside the state, but you're still registered to charge and collect tax. That's a use tax collection responsibility, and we can refer to it as retailer's use or vendor's use. And then thirdly, what I referred to earlier about purchases, you can have consumer's use tax. Those are the three basic or primary components. But within that, within the overall registration application, there could be any number of additional tax types. In Florida, you'll probably find that there's some communication services taxes that you could accidentally register for or inadvertently register for that instead of the appropriate sales tax. There can be other unique tax types, excise taxes associated with cigarettes, tires, alcohol. You check the wrong box and you can really put yourself in detriment with the state along those lines. So it's just important to understand what it is you're doing. And I will tell you that even myself, I have found in my efforts over the course of time, sometimes to go online and register, it really gets confusing as to what you're registering for. And so you can start into a state or maybe a city's registration portal, and it says register the business, or it says something along those lines that makes you believe this is where you go. And you start entering a bunch of information, and you get to the very end, you hit submit, and you kind of go, well, what did I just do? It asked for a lot of information from me. It gathered data that I could assume associated itself with sales tax, but in reality, you did nothing more than register for a business license in that state or in that city, and you didn't accomplish what you set out to accomplish. And I tell you that because, again, I've a person that knows sales tax somewhat well and has been in this sort of industry for 34 years now. I sometimes will find that to be a challenge even for myself. So just something to be cognizant of.
And even those different tax types, certainly in some states, even if you're looking at vendors' use tax versus a traditional sales tax, it might be a different rate or even a different form, different return that you have to file. So that's important to note. And I'm going to segue into a question because you were referencing it's a good time to talk about this, the consumer's use tax piece of it. All right, let's move on to the next topic here, which is setting and forgetting your compliance process.
I'm gonna back up just a step. There were a couple of things I just wanted to mention on the last slide, and that is that due dates vary. Just like taxability varies by state, due dates vary by state. You don't have to go back on the slide, but due dates can be as early in the month as the 7th business day, meaning you might have an obligation to file something and report something for the prior month on the 7th calendar day of the subsequent month. That's pretty tight. Usually that's a prepayment. Usually it's some kind of deposit that you're having to make that's kind of pre-calculated. There can be 10th due dates. The more common due dates are the 15th, 20th, and either the 30th or the last day of the month. Those are the most common. And the 20th due date on a monthly basis is the most common. There are a few states, in fact, since we just got off Ohio's a little unique. Their filing deadline, I believe, is the 23rd of the month. There's some states where it's the 25th of the month. Sometimes the date of the month that the return is due is predicated on whether or not it's a monthly return or a quarterly return. So it might be that the quarterly return has a 30th due date and the monthly return has a 20th due date. So there's just all these variables, complexities that you don't anticipate until you get into this thing. And it's another reason to make sure you've got adequate compilation of that data in your tax calendar. So this slide, setting and forgetting your compliance process. As we've talked about, I've established nexus. All right, I've established what's taxable, what's not. Okay, I'm comfortable. I've gotten registered. Okay, now I've got some responsibility for calculating the tax on every transaction, or at least on the transactions that are taxable. We leverage different tools for that purpose. Some companies, they've really got a homogeneous product or service type that makes it easy to determine tax, and all they really need to keep up with is the rates. Where's the situs of the transaction? Other companies have very complex SKUs throughout their business model, and in some states, maybe those SKUs are all taxable at a single rate and don't have any special rules, and in other states, the states may vary as to which products are taxable or exempt. Some states will even have reduced rates for certain types of products. So there's this variability out there that you've got to account for. And the part that makes this even more fun is that rates change periodically and taxability can change periodically. And then there's things that kind of pop up that we may not anticipate, such as holidays. A lot of times there's tax holidays offered. A lot of times these are associated with school, so that kids, as they're finishing up the summer and getting ready to go back to school, can go out and buy clothes and school materials exempt from sales tax, and so it helps families in that regard. But there's a lot of change that can happen. Another thing that you've got to be aware of is that the states can change your filing frequency at any time, and you may get notification of that online. You might or might not get it in the mail. And either one of those, if it's one or the other, can be a challenge, because if it comes in the mail and you're the lowly person in the sales tax department that never gets mail forwarded to them in the company, somebody up front decides that's not important, all of a sudden you might have delinquent returns if they've increased your frequency. Online is a scenario where you might just have a message in your portal. And if you're accustomed to going into those portals and filing regularly, you've probably got a routine, and you're filing in multiple states, and you're kind of going through the paces every month. You know what it needs to do. However, you kind of lose sight of the fact that there's a message center there that maybe has hopefully an alert for you that you've got a message that you need to attend to. And it's very, very important to understand that, because a lot of states are communicating that way today. And it can happen that you get a message or a notice that gives you 10 days or 15 days or 30 days to respond. And some of these states will, if you've not responded, they'll say, well, this is a jeopardy assessment. You're being assessed $10,000 arbitrarily because you've not been compliant or responsive to our notices, and you have 45 days to respond or appeal. And if you fail to respond or appeal in that 45 days, that becomes a final assessment. And now they can lien your property, and they'll come after you, and you have no way to mitigate it. So it's just important to understand that all those factors exist out there. We just need to be aware of them. The thing that I think we also are challenged with, and this will sound like I'm going to talk disparagingly about some of our competitors, but it's a reality. I use TurboTax for my income tax returns. TurboTax, great tool. I use it every year. It's a do-it-yourself tool. I've got to navigate through the variables that both the technology present to me as well as the documentation I have to compile and include in the reporting mechanism. And everybody's experience with TurboTax is going to be different. Again, I use it and I'm not complaining about it, but it's kind of a do-it-yourself kind of model versus carrying my documentation over to my CPA, dropping it off on his desk and saying, have at it, send me a bill. That's a different experience altogether. And then there's hybrids of those two things. What I wanted to just share with you, though, is if you go down the path of an automated solution, a platform that kind of gives you the service of calculation as well as filing or managing some of your filings, just understand there's probably going to be some key elements in that you need to own and that you'll have responsibility for. It could be that you're responsible for identifying and communicating any calendar filing frequency changes. It could be that notices are your responsibility. You're responsible for going out and getting them or receiving them in the mail. It could be that you're responsible for determining and turning on different taxes within a particular state that might have state level taxes as well as what we call home rule taxes, city level taxes that are self-administered that are filed separately. So there's just, it's important that if you go down that path to just understand that those things could be responsibilities of yours or your company's, and you don't want to just set it and forget it.
Yeah, Jeff, I think I frequently talk about this in terms of where the automation is most effective within the sales tax process is really at that point of calculating the sales tax. So integrating, a third-party sales tax software solution with the invoicing system so that when you create an invoice or when you are in a shopping cart and that tax gets calculated, as you referenced, depending on the complexity, the number of states, the different SKUs, the automation is absolutely critical in those scenarios. And you referenced telecommunications services as an example, which is extremely complex from state to state, where even if you're in a single state, you almost have to have an automated tax calculation platform in that scenario. And most of the challenges, as you described, that we reference it here as tasks left for you to manage, really kind of fall more on the registration and filing piece of it. But just kind of recognize that big proponents of automation, it just needs to be leveraged in the right spot.
Brian said that we would talk about exemption certificates later. This is later. So as we discussed, there are exclusions, things that are never taxable. Certain types of services kind of fall into that category. And then there's exemptions. And the exemptions, as I described earlier, can come in the form of exempt entities, nonprofit organizations, state and local government, manufacturers. It could be the way they're doing business. Maybe they're buying product for resale. So when Walmart buys all of its inventory that stocks its shelves, it's issuing a resale exemption certificate to its distributors or its suppliers. These exemption certificates and forms are critical to mitigating the exposure of a business. And if you're not in a position to produce an exemption certificate to substantiate an exempt transaction, the state is going to assert that you're liable and that it is taxable until proven otherwise. Now, it's true that the states, in almost any circumstance under audit, they'll give you an opportunity to go back to your customers and get those certificates. They'll threaten that you're not going to be able to do that, and you should really think about it in that way, because the most common scenario that we find is that companies have gone out of business, or there's just no attentiveness on the part of the customer anymore. You don't have a business relationship with them, and they're not going to give you the time of day when you try to go back and get it later. So make sure you're prompt and effective at getting in place an exemption certificate when it's necessary, up front or as close to the time you made the sale as possible. They really need to be dated on or before the sale. Most of these exemption certificates, they can be what we call general exemptions across the board, meaning everything they're going to buy from you as a customer are going to be exempt. Some exemption certificates can specify what products or services they're buying that are in fact exempt. Expiration dates. A lot of states will tell you that their exemption certificates never expire. They're valid until rescinded by the customer. We recommend you try to update your certificates with recurring customer relationships every 3 years. It just keeps you abreast of any changes that might have happened with the company, and it also keeps it relatively fresh for your records. And states, again, as we said before, are prone to change. So what one state might call a valid certificate that's valid in perpetuity, 2 years later might say, well, we've changed our mind. Now all certificates expire every year, and you're going to have to make sure you get it updated. So if you have this regular cadence of every 3 years updating your certs, it's a healthy practice. And when you get a certificate, it's important to understand that there is an unlimited sort of number of formats that you might receive in the way of exemption certificates. And what does that mean? Well, this can include states that have a very specific prescribed company-specific certificate that you go onto their website, you print it out, and you issue it to your your vendors. And it can also be a form that you print out off of the state website that you then fill in with your company information, your registration number. You check an applicable box that tells the vendor what it is you're buying and why you're exempt. And then there's a signature and a date. Very, very critical that all those elements are represented in any certificate you receive. And lastly, there are a number of states that will allow companies to issue basically affidavits on their own letterhead that constitute exemption certificates, so long as they have the prescribed requirements of that certificate. And prescribed requirements typically include name of vendor, name of customer, what is being purchased, or what's the nature of what's being purchased, what's the nature of the exemption, is it for resale or is it some other type of an exemption, and then it needs to be signed and dated. So that complexity across 50 states, or maybe not 50 because there's 5 states that don't have a state sales tax, but that complexity and broad application of rules around exemption certificates can make it very challenging. So you've kind of got to get educated or self-educate yourself in terms of what's acceptable. And usually that plays out by industry. You know, you're usually practicing or selling into an industry where you start to see similarities across states for that specific industry. But some companies sell to everybody, and it can be a real challenge for them.
With the different types of exemptions that someone might have you ever seen an issue under audit where, I know a lot of times people just take exemptions and put them into a other category, or they just put them all into resale, but they might have, some exemptions might be resale, some might be to nonprofits, and some of the returns have different lines for the different types of exemptions. Is that anything to be worried about in terms of what line to put them on?
Yeah, it is. And as Brian described it, I think Pennsylvania is a good example of what Brian was describing. You go to their exemption certificate, and then I believe Pennsylvania's certificate encompasses all those things I've been describing: exempt entity, nonprofit, resale, manufacturing. And depending on which box you check, you have to have the appropriate or requisite account number. So not only, and I kind of left that off of the requirements I just described, so I'm glad you asked this question. But in those, when I described affidavits, sort of custom forms, you do have to have your sales tax account number represented in that form. That's another pretty daggone critical element. So in states like Pennsylvania, there's usually going to be a line or a space where you can provide your registration number. And in some states, that registration number format dictates what kind of exemption you're qualified for. And if you're checking the wrong boxes, checking the wrong line, the state will usually and generally disallow that exemption. And you'll still be given an opportunity to go and recover and get a new exemption form. But it's very important to make sure you review every exemption certificate you receive. And don't be surprised if you receive 1 out of every 5 exemption certificates that are inaccurate. Maybe they're not completely filled out, or they're just not even resembling a valid resale exemption certificate. We've seen just about anything you can imagine in terms of claims of exemption. So just be diligent in that regard.
Appreciate everybody's time, and have a good afternoon.
Thank you, everybody.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.